This is why tax strategy is so fun to me, because I like taking tax strategy from the perspective of the IRS, not from the perspective of, what am I doing? I want the IRS to, if the IRS were to audit me, I would want to know exactly what they would look for and what they would need to see in order for them to know that what I'm doing is truly a legitimate business with legitimate business intentions. So what I need to do is be able to create a business plan for my C corporation and formulate proper operating agreements that establishes the relationship between my C corp and my S corporation, which also means that my S corporation's operating agreement should have inside of it why there's a C corporation that manages it as well. So there needs to be documentation on both ends of the table. There needs to be documentation on the C corporation around the services that it's performing for the S corporation. And there needs to be underwriting inside of the operation agreement of the S corp for there to be a management role and a management fee being paid out every single year. And this is information that we've come to learn based off of working with a lot of clients that have multiple entity structures and dealing with these clients' audits that have given us insight on how to leverage this code to the fullest extent.
This is powerful stuff. And it sounds like people would be crazy not to have a C Corp. For example, we're trying to reach $1 million in our main entity, our LLC marketing agency, so that we have a few months of rainy day funds. God forbid something goes wrong. But in order to get to that number, we're going to have to pay taxes on $1 million, which is crazy and probably at that 37% rate that you just mentioned. So we could start the C Corp, transfer the money over, and only pay 20% as long as we've got our ducks in a row. Are you telling me that that's a 16, 70% tax savings that we could get?
That's 100% correct. Yeah. You can establish an off-year C corporation with a fiscal year end of September of next year and move money over, and 4 months and 15 days when it ends its year is when it will have to file its tax returns. So if I established a C corporation, let's just say right at the end of the year in December, this year of 2023, and I create the C corporation to have a year end of September, well, 4 months and 15 days, right? Because April 15th is 4 months and 15 days at the end of the year. 4 months and 15 days from the end of my C Corp's fiscal year is when it has to file its tax returns. So that technically wouldn't be until January of 2025.
Jesus.
So this is a strategy that you can play all the way up until the end of the year based off of the net profits of your S corporation.
So Karlton, you're blowing my mind right now. Why don't people have C Corps? Are there any drawbacks? Are there any pitfalls?
Yeah. So initially the C corporation gets a lot of hate because there's double taxation when you take money out of C corporations. So if I was operating my company as a C corporation, first off, it's not considered a flow through entity. So what that means is I actually have to pay taxes in my C corp, and then I have to pay taxes personally anytime I want to take money out of the company. Whereas an S corporation, it's all flowing into my individual tax returns, all the business's profits and all of the income I take out of the business. And I only pay taxes just on one single tax return. And this is part of the reason why most people will go down the S corporation route over the C corp, is because they know that they want to take a salary out of their company and they don't want to be faced with the double taxation. But what if you had an S corporation in combination with a C corporation? You get all the benefits of an S corporation, you get all of the flow through benefits, but you also have a C corporation that's set in a different fiscal year that you can send money up to and create a tax deduction for your S corp every single year with the ability to use those funds that are taxed at a lower tax rate without drawing a salary from the C corp.
This is all crazy stuff. Thank you, Karlton. I don't want to spend too much time on the interesting stuff, which is what we're at right now. I'm getting a ton of value right now. I know the audience is too, but I'd love to pick your mind on some of the next level stuff. See, as you level up from where we are now, or maybe we're where you already are, but the ultra wealthy, the people that have amassed such a large sum of money that they're just trying to protect it, minimize their tax burden, and they're willing to go that extra length. Tax attorneys, overseas accounts, trust funds. What are some of those vehicles that the ultra wealthy can use to minimize their tax burdens? Why does Donald Trump not pay taxes?
Donald Trump pays pretty much virtually no taxes just due to all the real estate losses that he has. He's one of the most notorious real estate investors in the United States. I mean, this guy literally owns hotels and golf courses. I mean, some of the best real estate you could possibly own is in Donald Trump's name or has Donald Trump's brand on it. And he's been honestly exploiting the accelerated depreciation laws for years. And part of the reason why he created the Tax Cuts and Jobs Act. He's one of the few wealthiest individuals that actually keeps everything on shore and shows everybody that by his ability to constantly reinvesting in what works, which is commercial and residential real estate. Donald Trump is somebody who's definitely provided a lot of affordable housing in New York. I've studied a lot of his works just for depreciation purposes, and it's definitely something that I teach other people to do inside of my coaching calls. When it comes to some of that more advanced stuff, you'll start to see some business owners move items out of their estate. And the reason why they'll do that that is because there's an estate tax exclusion that we have of about 24 million that sunsets after 2027. What I mean by sunsets, it ends after 2027 and it reverts back to the previous laws before the Tax Cuts and Jobs Act, which really only gave people about 11 to 12 million that they can put in their estate without it getting subject to estate tax, which can be as high as 40%. So what many people will do is they'll try to get assets out of their state by setting up irrevocable trusts for a better pronunciation of it. So when they establish these irrevocable trusts, they're taking assets out of their estate, but they may have multiple assets. It could be stocks, it could be businesses, it could be investment properties. So they're setting up multiple different trusts, maybe business complex trusts, family trusts, foundation trusts, because they're philanthropic as well. And all of these trusts have a relationship to each other, and all of these trusts have assets that get moved. And this is how you're able to build wealth strategically and also fly under the radar, because creditors are not allowed to get into trusts. They would have to go at the Supreme Court level because it's contract law that we deal with when we're setting up irrevocable trusts.